If you want to know where the smartest money in America is moving right now, this is the video for you. Institutional investors, private equity groups, and major family offices are making big bets across the Southeast and Mid Atlantic. Today, I'm breaking down the deals that matter most based entirely on CoStar research. But before we jump in, make sure you like the video, subscribe to the channel, and turn on notifications so you never miss a breakdown that impacts accredited investors. Let's get started. Today, we're reviewing major commercial real estate moves across Birmingham, Hampton Roads, Virginia, and Washington, D.C. If you're an accredited investor or you think you might qualify, this will show you exactly where all the institutional capital is moving and how these insights can help you position your own portfolio. Let's jump in and get started down south in my neck of the woods, Birmingham, Alabama. And so one of the big things here that I love with Birmingham is really the commercial real estate landscape and the affordability, the cash flow. And that's what's always drawn me down to the state of Alabama as an operator myself. But kicking off there, a fully leased Class A office building at 3535 Colonnade Parkway sold for $140 million, more than 669,000 square feet. This is the type of stabilized asset institutions love because it delivers predictable long-term income. Next, we had a major multifamily community, Stonegate Apartment Homes, traded for $47.15 million, more than 300,000 square feet. Multifamily remains to be one of the strongest institutional strategies. Stable demand, resilient occupancy, and strong tax benefits. That's one of the big reasons that I love multifamily. And, as I look at a lot of the institutional funds that are raising capital right now from accredited investors and just where we are going, we know right now construction is at a multi-year low, multi-decade low, really. Just the higher interest rates the last couple of years have really hit the pause button on a lot of new construction, which in return, once all these new units are delivered to the market and they're absorbed, we're not going to have any new inventory, and especially in these large metropolitan areas where we have a lot of population growth and a lot of jobs still coming in. But also, we saw in Birmingham an Aloft Hotel in Homewood that sold for $18.25 million. So hospitality in a walkable, mixed-use district continues attracting investors looking for strong revenue opportunities. And then lastly, in Birmingham, we had a 55-acre land parcel at 201 Milan Parkway that sold for $17.2 million. Potential data center development, one of the fastest growing sectors in commercial real estate. And then rounding out Birmingham, guys, we had a 3-property industrial portfolio that sold at $12.6 million. Industrial remains one of those most stable asset classes, especially as we start looking at logistics and Amazon, and right now with the buy now prime delivery, that a lot of the industrial just-in-time deliveries require industrial warehouse space for things to be delivered in a timely fashion. And so those are some really good staples that are showing great traction in Birmingham. And I see on the institutional side with some of the funds and the business practices and where they're focusing it, the Southeast. And so I think this is really big for those investors that are really interested in getting more diverse exposure and diversifying their portfolio outside of the stock market, because we see the roller coaster of the stock market is real. And even Bitcoin and some of the alternative assets that you have with the different kind of coins, even with the market and where we are right now with Bitcoin and other crypto, that they are having challenges, even at the same time as Wall Street. So the thing that you need to really look at as an investor, how can you find uncorrelated investments, alternative investments backed by real assets to be a hedge against inflation? And so with that, let's roll into Hampton Roads and really look what's going on right down the street here in Virginia. So as we shift to Hampton Roads, we had a multifamily investment activity that's really, really picking up. A New York investment firm, they acquired a 2-property portfolio of 340 units across Chesapeake and Elizabeth City, North Carolina, for a total of $58 million. But then also another significant deal that happened was a 295-unit Class A property in Norfolk, Virginia, built in 2024, now rebranded District 757. It was 96% leased up and with Fannie Mae financing. So this really shows strong institutional conviction in newer high amenity multifamily assets And I can guarantee you they probably bought it. It's no probably in it. They definitely probably got it for less than replacement cost. If you would go in 2025, 2026, and you're looking to rebuild this asset, that they got it for cheaper than new construction costs. And that's where a lot of companies and funds are going in to add value in these deals. It just shows that strong institutional conviction in newer high amenity multifamily assets across the board. And then why are investors targeting Hampton Roads? The CoStar data shows the region did not overbuild during 2022 and 2023. We just talked about that down south. And just that's where everything is at. And so supply is tight, demand is steady, vacancy is down to 6.1%, and rent growth is expected to outperform the US average heading into 2026. And this is where the data is really driving a lot of the investment. And you, as an accredited investor, need to be following the same data as you're making investment and aligning with yourself with these deals. Because guess what? You don't have to go and buy a $40 million apartment complex by yourself, but you can invest your money along these institutions, along with the family offices and high net worth individuals that are investing in these same institutional assets to build wealth. And then lastly here, we'll move to Washington, D.C., and looking at the private capital side. So a major private market firm, Broad Creek Capital, just completed the first round of fundraising as they raised $150 million for multifamily investment fund. This is the first time that they've opened beyond family offices and invited larger institutional investors. And so really that's one of the things that, as being the alternative investor director and working as a financial advisor, is really understanding how these funds move. That some they don't let in just any Joe Blow accredited investor. For those that know what accredited investor is, that's someone that has made $200,000 as an individual the last 2 years, and with the likelihood of doing that again in the following year, or they're for their household, them and their spouse, they have a total household income of $300,000 for the last 2 years, with the mind that they're going to make it again going into the next year, or they have at least $1 million net worth. So with those, allows you to define yourself as a accredited investor, or if you have a securities license like the Series 65, Series 6, Series 7 licenses, allows you to be deemed an accredited investor as well too. And so a lot of funds are starting to allow a lot of accredited investors invest with them alongside capital that they're bringing in from family offices and elsewhere, that normally have been reserved for large deposits for coming in from Wall Street. And so I think that's one of the big things that we see now is just the access to Main Street in some of these large deals. And so really their first acquisition here, Loft 135, a 298 unit apartment community in Charlotte South End, they purchased that for $94 million, which originally the original buyer bought it for $78 million back in 2016. And so we all know Charlotte South End has strong absorption. And even though vacancy is higher due to new openings, CoStar expects it to fall as construction slows down. We just talked about that. And I think one of the big things that really hits home is when you're looking at the trends in the data and vacancy, like we have a affordable housing crisis across the United States right now. So landlords that can provide quality and affordable housing, you're going to be winning long term in this market, especially if inflation starts to trickle back up. But one of the big things here, when you look at this area in Charlotte, that Broad Creek, they're focusing on workforce housing in high growth markets. They use a private equity style approach, operational improvements, renovations, and long-term income growth. They're planning a second close in early 2026. A company right at my heart. You know, that's one of the things. I'm a value add guy. I love buying assets that have mismanagement. They also have operational challenge in regards to not keeping up with routine maintenance and deferred maintenance, which allows us to go in, do the renovations, make the improvements, and then bring the unit up to market rent. And that's how we force appreciation in multifamily. And I think at the end of the day, what it really comes down, when you look across Birmingham, Hampton Roads, Washington, D.C., one theme stands out. Institutional capital is pouring into multifamily, industrial, hospitality, even office. And of course, we know data center land, because data centers are booming right now. I was just reading an article in Alabama of how Alabama Power has allocated 300 miles of high-speed fiber with all the new data centers going on. For those that don't know, Montgomery, Alabama, Facebook or Meta has invested over $1.5 billion with a B in data center footprints there in South Montgomery. And they're being followed by other data centers. And so now they're collapsing on the area because high speed connectivity is extremely important. And so that is one of the things that Alabama and the infrastructure is really making a play to bring in a lot of these data centers in order to generate a lot of revenue. Where I live right now in Loudoun County, Virginia, I went to a Chamber of Commerce meeting last year, and data centers for our county alone in Loudoun County provides over $1 billion of tax revenue to the county. Over $1 billion in taxes paid every year from data center providers in our county. So this is going to be huge for Montgomery County and Alabama. We're bringing in hundreds of millions of dollars of revenue from data centers. So the thing at the end of the day, these moves are driven by strong fundamentals, population growth, and tight supply. And as a credit investor, guys, you can access similar strategies through alternative investments and private market opportunities. The key is staying informed and understanding where capital is flowing. If you want to dive a little bit deeper and get a really succinct breakdown like this, insights on private markets and alternative investments, and education on how accredited investors build long-term wealth, then just simply join my exclusive accredited investor newsletter. Inside, I share institutional deal flow, market insights, tax-efficient wealth strategies, and simple, actionable guidance. Use the link below to subscribe and get the next version directly in your inbox. And if you found this video valuable, please make sure you like, subscribe, and drop a comment to help more investors discover this content. Let's go and let's make some equity happen together, guys.